How do you even make sense of a stock that has suffered this brutal year-to-date slide, but is flashing wildly conflicting sell and strong buy signals on the daily charts?
Right, and at the exact same time, it's being hailed as massively undervalued by fundamental analysts. It's the ultimate market paradox.
It really is. I mean, you're looking at a business that is literally doubling its top-line revenue, right? But then they're burning cash at a rate that has traders completely polarized.
Yeah, exactly. You've got one camp that sees the next major AI infrastructure play, and the other camp just sees, a classic tech illusion.
A total house of cards.
Mhm.
And that contradiction is exactly what we're tearing into today. So welcome to the deep dive.
Happy to be here to sort through this mess.
Before we start mapping out this battlefield, just a quick housekeeping note. If you're joining us on YouTube, hit the like button, subscribe to the channel. And this is compulsory, by the way. Leave a comment down below with your feedback. We genuinely want to read your take on this setup.
We really do. And just to be crystal clear right out of the gate here, this deep dive is strictly an educational analysis of the data and the sources.
Right. Absolutely not financial advice.
Exactly. We're just here to decode the underlying mechanisms driving the price action, not to manage your portfolio.
So let's set the stage. The subject of today's deep dive is SoundHound AI Inc. They trade under the ticker symbol SOUN.
Right.
And looking at the quote, as of April 17th, 2026, it closed at $8.08. It actually popped 4.94% for the day.
Which is a really strong daily close, especially when you consider the broader sector conditions right now.
Yeah, a very strong close. But the narrative pivot here is what's truly bizarre to me. The momentum over the last month is just wild.
Oh, it's everywhere.
Right. I mean, it's up 25.66% over the last 30 days alone. But then you zoom out and the reality check hits. It is still down 27.2% year to date.
Yeah, after a really sharp pullback from its earlier highs.
It's like jumping on a ride that just dropped 100 feet but is suddenly rocketing back up. Like, should you buckle in or get off?
That whiplash is really the core of the whole debate. And our mission in this deep dive is to figure out if this recent 30-day upward momentum is, well, a sustainable fundamental recovery, or if it's just a structural trap waiting to snare unsuspecting momentum traders.
Right. Because we can't just look at the stock price in a vacuum.
No, definitely not. We need to start with the raw financials to see the engine under the hood, then map out the technicals and options flow to see how people are actually positioning.
And finally, decode that intense bull versus bear debate happening on Wall Street. So let's start right at the engine block, moving from the price action into the fundamental financials.
Okay, let's get into the numbers.
The income statement actually paints a picture of hypergrowth. If you look at the annual numbers, 2025 revenue hit a record $169 million.
Which is massive.
It's nearly doubling year over year, and the top-line momentum is accelerating too. Their 2026 guidance projects revenue somewhere between 225 million and 260 million.
Yeah, and those growth rates are undeniably impressive. I mean, doubling revenue at that scale requires serious operational execution.
For sure.
But, and this is a big but, we have to cross-reference that income statement with the balance sheet and the cash flow statement, because that is where the tension really lies.
It's a reality check.
Exactly. So SoundHound carries a market cap of approximately $3.44 billion right now. And the liquidity is phenomenal, right? It averages about 25.7 million shares traded daily.
Wow, that's a lot of volume.
It is. But despite that multi-billion-dollar valuation and the massive revenue acceleration, the company reported an operating cash flow of negative $21.89 million in the latest quarter alone.
Negative 21 million in one quarter.
Yes.
And the bottom line reflects that, right? I mean, their Q4 2025 earnings per share came in at a loss of 2 cents.
Right, which met Wall Street's estimates,
But a loss is a loss. Okay, let's unpack this. So they are doubling revenue, which is like, I don't know, driving a sports car at 200 miles per hour. But that negative cash flow means they are actively leaking oil over the entire track.
That is a perfect analogy.
Like, how long can they keep that up?
Well, that's the multi-billion-dollar question. Growth in the artificial intelligence sector requires immense capital expenditure. You've got server compute, talent, constant iteration.
Right, it's not cheap.
Not at all. But burning through over $20 million in cash in a single quarter while still posting net losses, that creates a very real ticking clock.
And the market's anxiety over that clock is perfectly illustrated by the 52-week context, right?
Oh, absolutely. Over the past year, this stock has violently swung from a low of 5.83 all the way to a high of 22.12.
That is a staggering spread for a multi-billion-dollar company. I mean, it suggests the market has absolutely no idea how to price this asset.
It suggests the market is warring between two mutually exclusive valuations. When the narrative focuses on their undeniable hypergrowth and AI technology deployment, the stock is aggressively bid up toward $22.
Right.
But then, when the reality of the cash burn and the macroeconomic cost of capital sets in, investors rotate out and it plummets back toward $5.
So that cash burn anxiety explains exactly why this stock is behaving the way it is on the charts. Let's look at the actual traders and insiders, because the technical setup here is fascinating.
It really is a battleground.
Yeah, because the short-term trend, driven by that 25% monthly jump we talked about, is showing real strength. But the long-term trend is still undeniably weak.
It is entirely trapped. The stock is currently suffocating below its 200-day simple moving average, which sits at 11.25.
Okay.
And until stock breaks above that long-term average, the macro momentum is technically considered bearish, regardless of how good of a month it just had.
Right, so the support floor holding the stock up right now is roughly between 6.72 and 6.76, with a hard capitulation floor down at 5.96.
Exactly.
But looking at the chart, there's this massive brick wall they have to smash through at that 200-day moving average. Like, are buyers actually strong enough to push past 11.30?
Well, that's the challenge.
Because there has to be a mountain of overhead supply from investors who bought the top and are just waiting to break even.
You've identified the exact mechanism of resistance there. Every time the price approaches 11.30, those trapped investors sell to get their money back, and that just floods the market with supply.
Yeah.
But the momentum indicators do suggest buyers are trying to build enough velocity to shatter that wall. The max EV is actually sitting positive at 0.24, which is flashing a clear short-term buying signal.
And the 14-day RSI is currently at 65.2, which is technically neutral, but it is pushing hard toward overbought territory.
Right.
So what does this all mean for someone looking at the short term? Because an RSI creeping past 65 is like a car engine revving into the red line.
It is.
It means buyers have been aggressively bidding this up for weeks without taking a breath, which usually precedes a sudden sharp pullback.
Usually, yes. Or a breakout, if the buying pressure is being forced by derivatives.
Yeah.
And that actually brings us to the most critical clue in our sources right now, the options market order flow.
Oh, this is the wild part.
We are seeing what analysts classify as highly unusual options activity. There has been a 50% surge in call volume.
That's roughly 92,140 call contracts, right? Who is buying all of that?
Retail traders. They are leveraging up aggressively with those 90,000-plus call contracts, clearly trying to force a short squeeze ahead of the Q1 2026 earnings report.
Wow.
And when retail buys that many calls, market makers are forced to hedge their books by buying the underlying stock. That creates a feedback loop.
Right, so the price isn't necessarily rising right now because of fundamental shift. It's rising because of hedging mechanics in the options market.
Exactly.
But the crazy part is, while retail traders are completely ignoring the balance sheet and leveraging up for a squeeze, the insiders are doing the exact opposite.
Yep. They are taking profits.
Yeah. In March 2026, the CEO and other executives sold 307,973 shares. That's about $2.1 million worth of stock being offloaded.
Now, to be fair, the filings do indicate that this insider selling was classified as routine.
Yeah.
Often these are pre-planned schedules for tax purposes or just basic diversification.
Sure, it's not a midnight panic sell, but you have to admit the optics are terrible.
Oh, the optics are definitely tough.
You have retail traders buying massive amounts of short-term leverage, while the executives actually building the company are taking long-term chips off the table.
Well, if we connect this to the bigger picture, it creates a highly unstable market structure.
It's a powder keg.
Exactly. If earnings miss even slightly, or if forward guidance is soft, the retail optimism fueling those call options evaporates in seconds.
Right.
The market makers unhedge, the calls expire worthless, and the stock price just collapses back down to the fundamental floor.
And that extreme divergence brings us right to the ultimate debate dominating our sources. Is SoundHound truly undervalued? Or is it just a classic value trap wrapped in shiny AI marketing?
It depends on who you ask. If we look at the analyst consensus, it sits consciously at a moderate buy. We have one strong buy, 5 buys, 3 holds, and 1 sell.
Okay.
And the average price target is 14.93.
Which is an 85% upside from where it closed today at 8.08.
Yeah.
And looking at the extremes, the most optimistic target is $20 from H.C. Wainwright, and the most pessimistic is $9 from Piper Sandler.
Which is really interesting.
It is. Even the most bearish analyst on Wall Street thinks the stock is worth slightly more than its current trading price.
And that provides a psychological safety net for the bulls. But the fundamental bull case goes much deeper than just analyst targets. Firms like Simply Walson argue that the stock's actual fair value based on future cash flows is 28.58.
Wow.
Yeah, so by their model, SoundHound is 71.7% undervalued right now.
71% undervalued? But their argument hinges heavily on the velocity of that revenue expansion we discussed earlier, right?
It does.
Yeah.
They believe that when a company is doubling its revenue in the infrastructure layer of the AI sector, the current price is just an absolute steal. You are essentially buying tomorrow's monopoly at today's discount.
And there are tangible operational catalysts fueling that thesis, too. Like the most significant recent development, the new partnership with Associated Carrier Group, or ACG.
Right, bringing SoundHound's agentic AI to Tier 2 and Tier 3 telecom operators.
Let's actually look at the mechanics of that, because agentic AI isn't just a buzzword here. Tier 2 and Tier 3 telecom operators are fighting for survival against the mega cap giants.
They really are.
They don't have the capital to build in-house large language models or like massive AI call centers from scratch. So SoundHound provides this plug-and-play AI agent that can autonomously handle complex customer service routing, technical support, billing queries, all without human overhead.
Yeah.
They're selling operational efficiency to companies that desperately need it to survive.
It is a brilliant go-to-market strategy. I mean, by targeting the regional operators, SoundHound is embedding its technology directly into vital telecom infrastructure.
Right.
And once a carrier integrates an AI agent into their core routing system, the switching costs to replace it later are just astronomical. It creates incredibly sticky recurring revenue.
But the bears are growling for a reason, and it really comes down to how much you are paying for that revenue. Right now, SoundHound's price-to-sales ratio is roughly 20x.
Yeah, a 20x multiple is priced for absolute perfection. For context, the broader software sector average is only trading at about 3.7x sales.
3.7 compared to 20.
Exactly. Investors are paying a massive premium for SoundHound's growth. And when you pay a 20x multiple, you expect an impenetrable economic moat. You don't expect glaring structural vulnerabilities.
And the sources highlight a massive vulnerability. Over 30% of SoundHound's revenue comes from a single customer.
Yeah, that's the kicker.
Wait, a 20x multiple when one customer holds 30% of your revenue? If that one client leaves, doesn't the whole house of cards come down? That perfectly explains why retail traders often get trapped here.
The concentration risk is severe. If you are a fundamental investor, that single metric is the loudest alarm bell in the entire financial profile.
I would be terrified.
It is the primary reason the stock experiences those violent sell-offs. The moment the market even suspects that primary client might reduce spending, the 20x premium evaporates, and the stock rapidly reprices as a distressed asset.
So we have this incredible tug of war. We have hypergrowth, vital telecom infrastructure partnerships, and fundamental models screaming that the stock is 70% undervalued.
Right.
But on the other side, we have severe cash burn, a massive wall of overhead supply at 11.30, a 20x multiple, and terrifying customer concentration. Synthesizing all of this, what is the actual outlook moving forward?
We really have to divide the outlook into two completely separate games being played right now. In the short term, meaning, the next few weeks through Q1 earnings, the fundamental valuation almost doesn't matter. The price action is going to be dictated by sentiment, options, gamma hedging, and the PR momentum from the ACG telecom deal.
So it's high risk, high reward volatility. It's essentially surfing on market psychology and retail leverage.
Precisely. But the long-term outlook is a completely different equation. Over the next 2 to 3 years, their survival depends entirely on executing on two fronts.
Which are?
They must outgrow those widening net losses to prove the business model scales profitably, and they must aggressively diversify their customer base to dilute that 30% concentration risk.
So what do the extremes of that long-term outlook look like? Let's start with the bull case.
Well, the best-case recovery scenario is compelling, because SoundHound holds a massive $1.2 billion revenue backlog, alongside over 220 patents in voice AI technology.
That's a huge backlog.
It is. And a backlog of that size means they have signed contracts that haven't even been recognized as revenue yet. If they continue deploying that tech successfully, they might not even need to achieve long-term profitability independently.
Oh, because that patent portfolio and the locked-in contracts make them an incredibly lucrative acquisition target.
Exactly. The bulls argue that a mega-cap tech company, someone looking to instantly dominate the voice AI infrastructure space, will simply buy SoundHound at a premium, rather than spend 5 years trying to engineer around their 220 patents.
Wow. But the worst case scenario is just as plausible, right?
Unfortunately, yes. In the worst-case continuation lower, the widening net losses outpace their revenue growth. The cash burn forces management to aggressively issue more stock just to keep the lights on.
Which heavily dilutes current shareholders.
Right. And if that dilution coincides with their single major customer reducing their contract, the fundamental floor drops out and the stock crashes violently back through that 5.96 support level, potentially never recovering.
Man, this has been an incredibly complex puzzle to piece together. To quickly recap the journey we've taken through our sources today,
It's a lot of data.
it is. We have a company that is successfully doubling its top-line revenue and signing new telecom deals, creating a highly sticky product ecosystem. Yet simultaneously, they are battling negative operating cash flows, defending a massive valuation premium compared to the rest of the sector, and fighting the gravitational pull of heavy customer concentration.
The data presents a picture of a company walking a tightrope in hurricane winds.
Seriously.
In a market flooded with AI hype and social media-driven momentum, understanding the underlying mechanisms, the cash flow realities, the options market distortions, and the structural concentration risks, that is your only defense against getting caught on the wrong side of the trade.
The real takeaway here is that SoundHound isn't being traded like a traditional software company. It's being traded like a lottery ticket on AI infrastructure. You aren't necessarily buying their current revenue. You're buying their 220 patents and their $1.2 billion backlog, and just hoping a tech giant decides it's cheaper to acquire them than to compete with them.
That is the ultimate wager the market is making right now.
You have to wonder, though, with that massive $1.2 billion backlog and those 220 patents, is SoundHound actually building a standalone AI empire that will dominate the next decade of voice technology? Or are they just meticulously dressing up the company to be acquired by a tech giant before those widening cash losses finally catch up to them?
It is a question that will be answered one way or another in the coming quarters.
Thank you so much for joining us on this deep dive. Don't forget to drop your predictions and thoughts in the comments below. We read every single one to see where you stand on the bull versus bear debate. Until next time, keep analyzing the data and keep asking the hard questions.